So one of the things at Harbourside and Shartru, Nick, that we're very keen on is risk-adjusted returns. And in that, with regards to your strategy, one of the things that generates your risk-adjusted returns is the fact that you return to cash in poor markets, shall we say. And perhaps you could tell us a little bit about how that works, how you identify the markets, and how that operates.
Sure. So we kind of take a top-down approach to start with. We look at the market and ask the question, is it trending up, yes or no? If the answer is yes, we step down a level and we look for the strongest stocks within the market. And we simply buy those strongest stocks, and we measure that by using momentum over the last year or so. That's a very robust way to do it. We buy those strongest stocks, and on any given date, usually a month interval, we will repeat that process. Now, if the broader market is still trending up, then we'll step back down, reevaluate the momentum of all the individual stocks. And if any have fallen out, that is, their momentum has dropped off, we'll replace them with one that has firmed up a little bit. So essentially, we're always invested in the strongest stocks and therefore the strongest sectors in the market. If the trend of the broader market does reverse and start heading down, then we will exit completely to 100% cash, and will remain that way until market conditions are favorable. We did this back in 2008, I think mid-2008, we went to cash. We sat there all the way through to early 2009. And once that market started bouncing again, we jumped on board again. So essentially, we're playing a good defense. And as a result, if we do have some kind of sustained bearish environment, we simply won't be involved in that at all. We'll sit in cash and then we'll get reinvested when the time comes again.
So in good markets and strong markets, we're basically in high beta stocks, outperforming sectors. We don't have to pick them. We don't have to predict them. They will find us, if you like.
Yes.
Just a mathematical equation. And in poor markets, we're returning to cash. Risk-adjusted return, that's obviously very good. But also the thing that I like is that on a correlation basis, when everything becomes highly correlated in poor markets, which is what happens, you return to cash, so we keep uncorrelated to the bad side of the market, if you like.
That's exactly right. Yeah.
In summary, that's what you're doing.
Exactly what we're doing. We're protecting our capital, and we're also protecting our psychological fortitude as well. The GFC was one of those long, sustained bear markets that did a lot of damage to a lot of people, not only financially, but also psychologically. We don't want to be a part of that, and we're just happy to sit on our hands. We've sat on our hands most of 2022, and as a result, to give you an idea, our US portfolio is basically down 0.5% compared to the S&P, down whatever it is now, 22%. So it's a game of patience. It's a game of taking a long-term view of the markets, and everything we've done has been highly tested and stress tested, and we're very confident going forward that we'll continue to deliver good returns.